Welcome. Today, we're breaking down Alphabet's third quarter 2025 earnings report. The data reveals a crucial turning point for the company, a clear shift from a long, expensive AI investment cycle into what looks like a period of significant financial harvest.
So let's get right to the core thesis. These Q3 results really validate the idea that Alphabet is turning a corner. Its long-term AI-first strategy, well, it's not just about spending money anymore. We're now seeing a clear, demonstrable transition into a phase of accelerated growth and, importantly, profitability.
Now, this isn't just a theory. This conclusion is anchored by some really powerful data points. We're talking about quarterly revenue topping $100 billion for the first time. We're seeing a massive surge in the Google Cloud backlog, a fantastic indicator of future revenue. And perhaps most importantly, AI is now a quantifiable driver of growth in both ads and cloud. So let's dig into these numbers.
All right, Section 1, the financial picture. We're going to examine the quality of this growth because, as you know, the headline numbers only ever tell part of the story.
Okay, if you look at the historical data here, you can see a really clear narrative unfolding. After a period of relative moderation in 2022 and 2023, there's a distinct inflection point. You see it right there. Growth across the board, revenue, operating profit, net income, it all began to accelerate sharply in 2024, and that momentum has carried right through into 2025. And the scale of this Q3 performance is, well, it's pretty remarkable. The results didn't just meet expectations, they blew past them. Now, 16% revenue growth is solid for sure, but look at that 35% jump in diluted EPS and 34% growth in Google Cloud. That points to some serious operational leverage at play here, and the momentum is clearly building.
But for me, perhaps the most significant forward-looking indicator is this one, $1.55 trillion. That's the total Google Cloud backlog. Think of it as contracted revenue that's already in the pipeline. It gives you a huge amount of visibility into future growth. What this really does is it underwrites those massive capital expenditures for AI. It's creating this really powerful self-funding growth engine.
So, to really get a handle on the quality of these earnings, a DuPont analysis is incredibly useful. It breaks down return on equity into its key drivers. And when we do that for Alphabet, it reveals that something fundamental has changed in their business model.
And here is the crucial trade-off they're making. On one hand, you see asset turnover dipping a bit. That's a direct result of all the heavy spending on data centers. The asset base is just growing faster than revenue right now. But look at the other side. Profitability is surging, with margins expanding from around 21% to almost 32%. So, what's happening? Alphabet is essentially trading a little bit of short-term asset efficiency for structurally higher profit margins. And that's what's driving a much higher quality of return on equity.
This leads us right to the heart of the matter, the AI engine itself. So in this next section, we're going to deconstruct it and look at the real, measurable impact it's having on the core businesses. For the last couple of years, this has been the central question hanging over Alphabet, right? Is generative AI a massive structural threat to its search dominance, or is it actually the next huge opportunity for growth? And this slide really gets to the core of that tension. The threat is pretty obvious: zero-click searches. AI gives you the answer directly, so you don't need to click on an ad-supported link. But the strategic response from Google is all about market expansion. The idea is, okay, maybe AI eats up the simple queries, but it also opens up a whole new market for much more complex, higher-value searches that just weren't possible before. And management's take on this is crystal clear. On the earnings call, CEO Sundar Pichai said their own internal data shows AI is actually accelerating the volume of search queries, including the commercial ones that make money. So the takeaway from their side is that this market expansion effect is more than making up for any potential cannibalization.
And this isn't just theory anymore. We're actually starting to see the financial contribution of AI in black and white. You've got hundreds of thousands of advertisers jumping on new tools like AI Max Ads. The company's talking about hundreds of billions of brand new queries unlocked by AI just in Q3. And this is huge. Cloud AI products are now bringing in billions each quarter, with revenue up over 200% year over year. The numbers are starting to get very real.
Okay, so beyond the financials, we really need to analyze Alphabet's competitive position. So let's dive into its strategic moats and its very unique hardware strategy for the AI era.
It's fascinating to see how each of the tech titans is playing to its traditional strengths here. For Google, the advantage is its incredible trove of consumer data and its control over the entire stack, from the silicon all the way up to the app. Microsoft, on the other hand, is leveraging its massive enterprise ecosystem, plugging AI right into the workflows people already use. And then you have Amazon, which is positioning itself as the foundational infrastructure layer, sort of the main arms dealer in the AI race.
Now, a huge piece of Google's full-stack strategy is its custom hardware, the Tensor Processing Unit, or TPU. This is an application-specific chip that they designed from the ground up just for AI workloads. The key thing to understand about it is its focus on power efficiency, on performance per watt. At Google's scale, that can translate into a massive advantage in both cost and performance.
And having this custom chip allows Google to run this really clever barbell hardware strategy. So on one side of the barbell, they offer the industry-standard NVIDIA GPUs on Google Cloud. They have to do that to compete and meet customer demand right now. But on the other side, they're developing their own TPUs. This gives them a long-term cost and performance edge, and crucially, hedges their massive dependency on a single supplier.
Of course, no analysis is complete without looking at the other side of the coin. So for our final section, let's turn to the key risks and headwinds that Alphabet is facing.
And really, the risks fall into three main buckets that you have to watch. First, there's the intense and, frankly, unpredictable global regulatory pressure. Second is pure execution risk. They're spending somewhere north of $90 billion on CapEx this year. That money has to generate a good return, or you'll see margins suffer down the line. And finally, that structural threat to search we talked about, the zero-click model. It's not going away, and it remains a persistent long-term risk.
So how do you think about all this in the context of the market? Well, some traditional models might get hung up on this massive short-term capital spending. But there's another way to look at it. You could argue the market is pricing in the enormous future potential of these AI investments. That gap you might see, you can think of that as the option value the market is placing on Alphabet's leadership position in this whole AI transition.
Which really leaves us with the big, forward-looking question. The Q3 numbers seem to confirm that the AI harvest is finally underway. But the real story for the next decade is going to be this. Can Alphabet's powerful technological moats withstand the ever-increasing pressure from regulators around the world? That right there is the key dynamic to watch.